Third thing we should think about is the bargaining power of buyers. This is once again the degree to which those who we sell to have the power to argue, in essence, you could think of, for lower prices. So what drives this bargaining power of buyers? Well, the industry is more attractive when buyers have less power, and there's a number of things to think about. First thing to think about is the degree to which the buyers are not concentrated. This is what we call monopsony, would be when the buyers actually have bargaining power here. And ultimately, it's a numbers game. Think about the idea of scarcity once again. If I am one of the few suppliers of a desirable good, and there's lots of buyers out there, one could imagine that I have a lot of bargaining power now over those who are seeking my products. Flip it around the other way. What if I am one of many different sellers of a good or service that there's only a limited number of buyers for? That puts the bargaining power with those buyers. So if you think about relative concentration in this number game, we can have situations where there are few suppliers and few buyers. This would be a situation we call mutual dependence here. It's unclear who would have bargaining power here. There could be situations where there are many buyers and many suppliers, and this would be your typical competitive outcome where no one has any real bargaining power, and you might just have simply a market price that prevails within the marketplace. But the off diagonals are where things get interesting. If there are few suppliers and many buyers, we refer to that as monopoly power. If there are few buyers and many suppliers, it's what we call monopsony power. An example of monopsony power might be the federal government when it comes to procuring arms for planes and other types of weaponry there. There is one buyer, potentially in the U.S. government, and there might be many suppliers of those goods and services in the economy, let's say within the U.S. Alone. So first, once again, the degrees to which the buyers are concentrated. If they're not concentrated, that works in favor of the industry. The second thing is the degree to which buyers have options. The fewer the options they have, and this gets back to scarcity again, the more bargaining power you have. So how do we think about options? Well, the first thing is to think about to what degree are products differentiated. If there's a high degree of differentiation, that works in favor of the industry. It prevents buyers from taking one product and playing off another in terms of what they're looking to buy. What we might think of as low intra-industry, within industry, cross-price elasticity here. So the degree to which there might be product differentiation or geographic differentiation, that's going to work to the industry's favor. To the extent we have what we might call commodity products that all look exactly the same, have the same features and the like, that's going to work to the buyer's favor here in terms of pricing and the like. Second thing to think about within options is the switching costs once again. So we can think about switching costs across product classes, as I originally talked about, beer, wine, and the like. But you can also think of that within a product class. Classic example would be the personal computer industry, where to switch from an Apple-based operating system to a Windows-based operating system is actually quite onerous. There's quite high switching costs in just simply learning the new operating system, perhaps changing your software, and other things that you would need to do to make that switch. We refer to this in economics as relationship-specific assets. If you have made investments that lock you into one potential supplier versus another, that is going to give power to that supplier. Another classic case here is if you're a coal mine and then you have a coal processing plant. If you locate that coal processing plant near the coal mine, well, now you've really locked yourself in because it's going to cost you a lot to relocate your plant near another coal mine, and it gives bargaining power to that coal mine. Another thing to think about is the degree to which the buyers can backward integrate. And what do I mean by this? I mean that the buyer could actually move up the supply chain, value chain, and start doing what you do. Now, let's think about Coca-Cola. What are the chances that your average consumer could go backward integrate and start to consume or make their own soda product? Highly, highly unlikely. However, imagine now the buyer is someone like McDonald's with a lot of scale and a lot of demand. It might not be unreasonable that when you're bargaining with McDonald's as Coca-Cola or Pepsi, that they have a threat here of backward integrating into what you do. And that backward integration threat gives them bargaining power in that relationship, perhaps allowing them to argue for lower prices than obviously the average public would pay. Third thing to think about are the degree to which buyers are segmented. price information is often not widely available, and because of that, it allows for businesses to segment their buyers based on their preferences. Consider the following in terms of what we call price discrimination. Here we see a traditional supply and demand chart here. Supply increasing, demand decreasing in quantity, quantity on the horizontal axis, price on the vertical axis. As we talked about previously, price and quantity for that market is determined where supply crosses demand, so you see PC and QC for this industry. Those two lines help determine what we call the producer and consumer surplus. In essence, if you think of that demand line as individual consumers who each would be willing to pay the amount where price crosses that line, one can think about the PC, the price that's actually charged, is lower for many consumers than what they would actually be willing to pay, what we call the willingness to pay. So the producer gets a surplus above and beyond the supply curve. Their price is higher than their supply curve, what they're willing, their costs are. But for consumers, it's also a surplus because for some of those, especially those further to the left, would be willing to pay a much higher price for the product than they end up having to with just one price set for the market. What price discrimination is when the firm is able, in essence, to charge different prices to different consumers in an attempt to grab that consumer surplus. So you see here, what if you could charge a different price to different consumers based on what their preferences are? This is in essence what the airlines try to do when they have different rates charged for whether you have a Saturday night layover or not, or whether you're ordering your tickets 21 days in advance or not. They know that if you don't have a Saturday layover, you more likely are a business customer, and as a business customer, you might be getting reimbursed by your employer, and as a result, your price demand is actually higher. You were willing to pay a higher price for a desirable flight than you would if you were spending your own money. So this is various ways in which they try to capture some of this consumer surplus. Now, in a first degree price discrimination, perfect price discrimination, you're able to charge exactly the price that each person demands. This is what auto companies try to do when they haggle. If they're really good at what they do, they figure out what each customer is willing to pay and charge them exactly what their willingness to pay is for the product, capturing their consumer surplus. Second degree price discrimination are ways in which you split the way you charge for products that will cause what we call self-sorting, that people divide up into different groups. In essence, the idea again in airlines where you might have a different fee, different charge, whether you have a Saturday night layover or not. So take the following example here. Imagine this is your following demand curve here. So think of our supply and demand charts now with a little bit of a step function in there. If you charge $60, you will sell 1 million of these units for, let's just say, a profit of 60 million. For argument's sake, let's say there's no costs here. On the flip side, you could charge $20 a unit and you'll now sell 3 million. So you'll sell more at a lower price, as one would expect, but your profits are the same here for 60 million. Well, what if you could charge the 1 million group $60 and the remaining 2 million group $20? Well, now your profits would be $100 million. This is the essence of price discrimination once again, and it relates back again to what type of bargaining power you might have. Finally, there are different ways you might sort by groups, and you see this by businesses quite often. They might recognize that educators pay a different different price for computers, let's say, than businesses and the like. What you see here is some data on what we call bundling, another form, if you will, of price discrimination, in which if you recognize there are different types of consumers, and if there's a different set of products, each with a different value, the WTP stands for willingness to pay for the product between those different groups, you can actually get a situation where bundling those products together, making customers or giving customers the option of buying, in this case, products A, B, C, D together, can actually raise the total revenues that you bring in, increase your profits as a result of that. It's beyond our lesson today to really dive into this notion of bundling, but I just wanted to highlight it again as another way of thinking about bargaining power. The degree to which bundling is possible gives bargaining power back to the industry. Let's move on from buyers now to suppliers. Very simply, suppliers are the mirror image of buyers. What you want of your buyers are not what you want of your suppliers. So for the industry to be more attractive, your suppliers are less of a threat when now your sellers are not concentrated. You don't want to have a monopoly supplier of some good or service that you absolutely need who could basically charge you a lot of money to be able to access that supply. You now want to have many alternatives. Now, before we talked about the buyers having few, you want to have many alternatives in terms of where your supply comes from. You want there to be many substitutes for your supplier products. You want, in essence, this commodity situation. You want to face low switching costs when you turn to your suppliers, and you want suppliers who cannot forward integrate into your business. It would have to be very difficult for them to move into your marketplace, removing that threat. Third, you want sellers not to be able to differentially treat different segments of the market. You want pricing information to be widely available and price discrimination to be limited, if not possible at all. In other words, you want a competitive market for your supply as a way to lower the prices you pay for your supply and avoid some of this bargaining power that you might face from suppliers. Take, for example, the personal computer industry. If you're a personal computer manufacturer, you have a huge threat to you from basically the Wintel monopoly. If you don't work with Windows, with Microsoft, if you don't work with Intel and their processors, you're likely to have what is determined to be an inferior product on the marketplace there. That monopoly power that they in essence have gives them incredible bargaining power in that marketplace and in that segment.